Hello, and welcome to our channel Pursuit of Wealth. This channel is your ultimate destination for learning about finance and wealth, investing and crypto, informational and educational trends in finance management. If you are someone who wishes to become wealthy and are looking for smart money management options, then we are fortunate to have found each other. Foreign exchange is also known as the FOREX rate or exchange rate, which tells the value of one country's currency in terms of the other country's currency. In simple words, this is the rate at which one currency can be exchanged for another. Well, most of the countries have their currencies. However, small economies use the currency of a bigger neighboring economy. El Salvador and Panama, for example, have chosen the US dollar as their currency. Many countries use the same currency in their respective countries. Like, the euro is used by 19 European Union nations is the best example of a common currency. Most international transactions require currency conversions for traveling, borrowing, selling, purchasing, hiring, or investing across national borders, with these notable exceptions. The foreign exchange market is where consumers or businesses swap one currency for another. The most influential market is the foreign exchange market, because the exchange rates are determined in this market, which is open to many buyers and sellers where currency trading is continuous. The three largest security markets in the world are Nasdaq, Tokyo Stock Exchange, and the New York Stock Exchange. The trading volume of these markets is enormous. According to the 2019 Triennial Central Bank Survey, the daily trading volume of the foreign exchange market is $6.6 trillion. This trading volume is larger than the annual GDP of China and the USA. The questions in your mind will be what exactly this market is. What's the point of its existence? Why is this exchange market so large? Well, keep watching the video until the end, as in today's video, we are going to look at the economics of foreign exchange. The foreign exchange market deals with the exchange of currencies between two countries. The rate of exchange depends on the value of money and the country's economies. All the financial structure exists and is traded based on foreign exchange. Let's discuss the essential factor contributing to the foreign exchange market, which is globalization. We can notice the increase in globalization day by day. Many businesses are growing. Every business wants to deliver its product to maximum countries to increase its sale rate. Every country has some specialized areas like China produces the cheapest products, Germany produces high-quality products, Japan produces the best seafood. So, if we want any of these things, we will import them from the respective countries. However, things didn't work like this about 100 years ago. A government could only produce locally or couldn't make it at all. The concept of trade was not known. People were hardly able to see imported products. The limitations of importing products were set to rich. It was a luxury to have an imported product like a motor car at that time, but the situation is opposite today, and that's because of globalization. If you visit any house today, you will hardly notice anything that is produced in your home country. The reason is that people started getting familiar with the term comparative advantage. This term highlights that do what you are good at. Germany can produce iPhones. They will do it easily if you ask them to make one, because they have the advanced infrastructure and the latest technical expertise to manufacture such devices efficiently. But everything which seems perfect isn't perfect at all. Germany has minimal and costly labor. Environmental regulations in Germany are also very strict regarding industrial waste, so it is not close to the component suppliers for this product. That's why German iPhones will be costly and could cost around $4,000 US. Similarly, China can build a high-end luxury sports car. China has demonstrated the industrial potential to develop and build its automobiles. However, they are not excellent. The reason is that China is a better fit for mass, medium-quality manufacturing, i.e., for manufacturing iPhones. China has a far larger, low-skilled labor force, fewer environmental laws, and factories that create the components that go into phones. The point of all this discussion is that rather than attempting to allocate some of Germany's resources and labor force to making expensive iPhones for itself, and China doing the same to create some god-awful automobiles, they will just agree to stick to what they do best. Germany will manufacture the cars, while China will make the phones. So this will give us access to a good number of high-quality vehicles and lots of cheap phones. Both of the countries will get the benefit by trading China's phones with Germany's cars. Germany receives more affordable phones than it could create on its own, and China gets better cars than it could produce. This is because each country has a comparative advantage for the product that they specialized in. This simplified example acts a bit differently in reality. One can't trade its 5 phones to get a car, so this trade happens by using currencies. Chinese manufacturers won't take payment in euros, and German car manufacturers won't accept Chinese yuan, so they will trade their currencies. The trade will occur between phones and cars and of euros and yuan, as a global business is directly proportional to the foreign exchange market. This has increased the foreign exchange market a lot. A typical autonomy dilemma is an increasingly unbalanced relationship between currency markets and national governments. The Mundell-Fleming model lays out the trilemma of economic policy alternatives open to governments. The model demonstrates that governments must choose 2 of the 3 policy objectives. 1. Domestic monetary autonomy, the ability to control the money supply and set interest rates, thereby controlling growth. 2. Exchange rate stability, the ability to reduce uncertainty through a fixed, pegged, or managed regime. And 3. Capital mobility. Currency demand and supply in the exchange rate markets. Demand and supply become intimately intertwined in foreign exchange markets because when a person or corporation that requires one currency must also provide another currency, and vice versa. Let's take 4 types of people who take part in a market to grasp the concept entirely. Visitors from other countries, importers, exporters, and service providers, international investors that are obtaining control of a company, international investors who do not have a stake in the company. Let's take a look at each of these categories. International tourists require foreign money to cover costs in the place they visit. They will exchange their currency for foreign cash. An American visitor who is visiting Japan, for example, will contribute US dollars to the foreign currency market while requesting the Japanese yen. Firms that sell exports or imports discover that their expenses for employees, suppliers, and investors are measured in the country's currency where they produce. At the same time, their sales income is assessed in the country's currency where they sell. As a result, a Japanese company selling to another country will earn another currency, say US dollars, but will need the Japanese yen to pay Chinese staff, suppliers, and investors. This company will be a supplier of US dollars and a demand of the Japanese yen in the foreign currency markets. Financial investments that span international borders and necessitate currency conversion are sometimes classified into 2 types. Foreign direct investment is acquiring at least 10% ownership in a company or establishing a new firm in another country. Portfolio investment, the other type of foreign financial investment, is a purely financial investment with no managerial obligation. A financial investor from the United States, for example, may buy bonds issued by the British government or deposit money in a British bank. The American investor would use the foreign currency market to provide US dollars and demand British pounds to make such investments. Several portfolio investment decisions are more complicated than just wagering on whether the value of a currency will fluctuate in one direction or the other. Instead, they include businesses attempting to protect themselves from fluctuations in currency rates. Assume a CEO of a company in the United States exports to Germany. He signed a deal to provide specific items and will get 1 million euros per year immediately. However, he has no idea how much this contract will be valued in US dollars because the dollar to euro exchange rate may fluctuate during the following year. Foreign direct and portfolio investments include an investor who contributes domestic currency while requiring foreign currency. A portfolio investment buys less than 10% of a firm. As a result, portfolio investments are frequently undertaken with a short-term horizon in mind. More than 10% of a firm is acquired with foreign direct investment, and the investor often accepts some managerial responsibilities. Hence, foreign direct investment has a longer-term focus. Portfolio investments, in practice, may be removed from a nation far faster than foreign direct investments. Players in the foreign exchange market. The foreign exchange market does not require final foreign exchange providers and does not demand physical seeking for each other. If Jack wishes to leave his house in New York and travel to the United Kingdom, he does not need to identify a UK citizen planning a journey to New York and arrange a person-to-person monetary exchange. Instead, the foreign exchange market functions on numerous levels and through financial organizations. Most people and businesses who need to convert a large amount of cash go to a bank or particular institution, and most banks provide a foreign exchange as a service to their customers. The foreign exchange is then traded by these banks or other organizations known as dealers. This is known as the interbank market. The foreign exchange market is massive, not due to the needs of visitors, businesses, or even foreign direct investment, but because of portfolio investment and the activity of interlocking foreign exchange dealers. International tourism is a massive sector worth around $1 trillion per year. Global exports account for approximately 23% of global GDP, or over $18 trillion each year. In 2012, foreign direct investment totaled over $1.4 trillion. However, these figures are dwarfed by the $5.3 trillion exchanged in foreign exchange markets each day. The majority of transactions in the foreign currency market are for portfolio investment, relatively short-term movements of financial capital between currencies, and are influenced by the actions of large foreign exchange dealers who continuously purchase and sell with one another. Foreign currency traders account for around 2,000 corporations in the global economy. The US economy has fewer than 100 foreign currency dealers, but the top 12 handle more than half of all transactions. Even though there is no central location for the foreign exchange market, the leading dealers keep a tight watch on each other at all times. Moreover, euro, Japanese yen, US dollar, and British pounds are the most traded currencies in the world. So, these currencies make up most of the part of the foreign exchange market. The US dollar is the top traded currency. It contributed 87% of the total amount traded daily. Many factors, including inflation, trade balances, economic growth, and government policies, potentially influence the foreign exchange markets. Well, that's it for today's video. Hope you get all the insights about foreign exchange and its economics. Don't forget to ask your questions and share your opinion with us in the comments section. As always, thank you so much for watching. We will see you at the next one. Please subscribe to the channel, like the video, and press the bell icon for more amazing content about wealth management and finance-related videos. Success is coming your way. Keep your doors open. See ya till the next time.